Imagine a company so dazzling it tricked Wall Street into believing it could reinvent energy itself. Enron didn't just grow. It exploded into America's seventh largest firm overnight. But one fateful day in 2001, that empire vanished like smoke from a burst bubble. Picture executives jetting on private planes while hiding mountains of debt. They cooked the books with tricks so clever even auditors missed them at first. Stick around because this story reveals how greed turned golden boys into prison inmates. Enron started humbly back in 1985 from a merger of two gas pipeline firms. Kenneth Lay took the helm after blending Houston Natural Gas with Internorth. He renamed it Enron in 1986 and set sights on bigger horizons. Deregulation hit the energy world hard in the early 1990s thanks to Congress. Natural gas sales opened to market forces across the U.S. Enron lost pipeline monopolies, but pivoted fast to trading energy contracts. Enter Jeffrey Skilling, a Harvard MBA, was hired as consultant, then COO. He pushed Enron into derivatives trading between producers and buyers. Traders fixed prices to dodge fluctuations, earning Enron fat fees every time. By 1992, Enron ruled North American natural gas sales with huge profits. Trading alone brought in $122 million before taxes that year. The bull market of the 90s supercharged their ambitions sky high. Skilling built a cutthroat culture, hiring top MBAs nationwide for endless deals. Andrew Fastow rose swiftly to CFO, crafting complex financing schemes. They traded everything from electricity and coal to weather contracts. Enron Online launched amid the dot-com craze, handling $2.5 billion daily trades. Stock soared from $83 in 2000 with market cap over $60 billion. Fortune named them America's most innovative large company repeatedly. But here's the hook that should chill you. Beneath the glamour lurked accounting sorcery. They hid billions in debt, using loopholes Wall Street adored. What if your retirement fund bet on this house of cards? Mark-to-market accounting let Enron book future profits as current revenue immediately. Long-term contracts got valued at present worth even if cash never flowed. SEC approved it first for gas futures back in 1992. A Blockbuster video deal in 2000 claimed $110 million profits despite doubts on viability. Enron kept reporting gains even after the project tanked. This fueled endless growth pressure to satisfy investor hunger. Special purpose entities, or SPEs, became their secret weapon for off-balance sheet magic. These shell companies funded risks hiding true debt levels. By 2100s existed obscuring billions from failed ventures. Fastow's Chewco bought out CalPERS from Jedi joint venture without showing debt. It kept losses off Enron's books until auditors caught on later. Whitewing snapped up $2 billion in assets using Enron stock as collateral. LGM Partnerships run by Fastow bought Enron's bad assets, improving financial looks. Raptors hedged merchant investments but relied on Enron's own soaring stock. When shares dipped, those hedges imploded, owing Enron billions. Enron's board waived ethics rules, letting Fastow manage these entities personally. They got updates, but lacked derivatives expertise to spot dangers. Audit committee meetings rushed through massive materials without deep dives. Arthur Andersen earned $52 million from Enron in 2000, split between audits and consulting. Conflicts blinded them to aggressive practices everywhere. Enron CPAs exploited GAAP loopholes, pushing boundaries relentlessly. Executive pay tied heavily to stock options bred obsession with short-term earnings beats. Top 200 highest paid grabbed $1.4 billion in 2000 alone. Stock tickers everywhere fueled a casino-like trading floor frenzy. Skilling asked at budget meetings what earnings kept stock price pumping higher. Lavish spending ruled, with expense accounts dwarfing competitors. Risk management tools ironically amplified dangers through self-hedging. Now pause and think. Executives sold millions in shares while praising the firm publicly. Skilling dumped $33 million worth before bailing as CEO. Wall Street cheered until cracks appeared in early 2001. Fortune's Bethany McLean questioned in March if Enron was overpriced at 55 times earnings. She puzzled over erratic cash flow and ballooning debt. Skilling snapped back, calling her unethical for not understanding fully. Analyst Richard Grubman pressed for a balance sheet during an April call. Skilling's explosive response became infamous company lore. Stocks still hovered high, but whispers of opacity grew louder. California's energy crisis spotlighted Enron's aggressive trading tactics harshly. They allegedly gamed deregulated markets, hiking prices dramatically. Dabhol Power Plant in India bled cash amid bribery scandals too. Skilling resigned abruptly August 14th after just 6 months as CEO, citing reasons. Lay stepped back in assuring no change in performance outlook. Stock dipped, but Lay claimed Enron stood stronger than ever before. Sherron Watkins penned a warning memo to Lay on August 15th, fearing accounting implosion. She met him detailing SPE risks, but he hired lawyers instead. Vinson and Elkins cleared Enron later despite her red flags. September 11th attacks briefly diverted eyes from Enron's mounting troubles nationwide. Lay planned asset sales like Portland General Electric for cash infusion. But investor confidence eroded fast amid related party deal suspicions. October 16th bombshell. Enron restated 1997 to 2000 earnings, slashing $613 million profits. Liabilities jumped $628 million, equity dropped $1.2 billion. Blamed broadband restructuring, but markets smelled deeper rot. Fastow admitted earning $30 million from LJM deals to the board October 22nd. SEC probed opaque insider transactions that very week. Shares plunged to $20.65, losing $5.40 in a single brutal day. Fastow ousted as CFO October 25th after banks refused loans with him in charge. Lay vowed to restore faith, but stock hit $16.41 quickly. Analysts demanded proof these earnings proved real and sustainable. Dynegy offered a lifeline buyout at a discount, sensing desperation. But Enron's credit downgrade triggered $690 million more obligations. Deal collapsed November 28th, sealing their dramatic fate. On December 2nd, 2001, Enron filed Chapter 11 bankruptcy with $63.4 billion assets. Largest U.S. filing ever until WorldCom topped it soon after. Stock cratered to pennies, wiping out $74 billion in shareholder value. Employees watched 401(k)s evaporate as they barred selling Enron stock holdings. Over 20,000 jobs vanished, pensions turned to dust overnight. Investors sued, clawing back just $7.2 billion from $40 billion claims. Andersen shredded Enron documents post-SEC probe, leading to obstruction conviction. Firm lost audit license, effectively dissolving operations. Supreme Court later overturned, but damage proved irreversible. Lay and Skilling indicted on fraud charges in 2004, facing massive trials ahead. Fastow cut a deal, testifying against them for lighter sentence. He admitted hiding losses, boosting earnings with Skilling's nod. Skilling convicted 2006 on 19 counts, getting 24 years in federal prison. Lay guilty on all 6, but died of heart attack pre-sentencing. Sentences cut later, but Enron's ghosts lingered in courtrooms. Sarbanes-Oxley Act born in 2002 from scandals, ashes, tightening financial reporting. Auditors banned from client consulting, harsher penalties loomed. CEO-CFO certification of reports became mandatory law. Wall Street learned hard lessons on blind faith in opaque financial wizardry. Energy trading firms adopted agent models, ditching merchant inflation. Confidence rebuilt slowly through transparency mandates everywhere. Watkins emerged hero, her whistleblower courage spotlighted corporate ethics needs. Books like McLean's detailed the smartest guy's epic room implosion. Documentaries replayed the fall for generations, learning. Enron's Mirage exposed how deregulation without oversight breeds monsters. Execs prioritized bonuses over reality until reality struck back hard. Your investments today owe safeguards to this overnight vanishing act. But wait, the real hook hits home. Similar tricks echoed in 2008 crisis with Lehman. Repo 105 hid debt much like Enron's SPE slight. Vigilance remains key in finance's endless game of trust. Fastow served over 6 years emerging to speak on ethics at universities now. Skilling, paroled in 2019, still defends some Enron moves publicly. Lay's death closed one chapter, but lessons echo eternally. Creditors recovered pennies on dollars through liquidation over years drawn out. Employees rebuilt lives scarred by betrayal's deep wounds forever. Scandal reshaped auditing, birthing independent oversight boards. Imagine betting your future on a stock hailed as innovative genius incarnate. Enron fooled them all until footnotes unraveled the grand illusion. What mirages lurk in today's market darlings waiting to vanish? This tale warns: chase real cash flows, not accounting fairy tales promising riches. Enron's overnight demise reminds even giants crumble on lies built. Stay skeptical, question boldly, because markets punish the blind hardest.